Good morning, investors. You are now on KleverStock with me, Anunjarya, serving you the latest morning bell updates. Kicking it off with the opening bell updates on our local market. The FPM KLCI opened sharply lower on Monday, plunging over 1%, as escalating trade tensions between Washington and Beijing rattled global markets. The sell-off followed U.S. President Donald Trump's announcement on Friday that the United States would impose 100% tariffs on China in retaliation for Beijing's export curbs on rare earth elements and related equipment. The fallout from the announcement triggered a broad market rout on Wall Street, where the S&P 500 fell 2.71% and the Nasdaq plummeted 3.56% on Friday. Now, the global downturn spilled over into Asian markets, although U.S. futures have since rebounded, suggesting that investors are still holding out hope for a potential resolution between the world's two largest economies. At 9 a.m., the FPM KLCI dropped 20.5 points to 1,601.75 in tandem with steep declines across the region. Japan's Nikkei 225 fell 1.71% to 28,880, while South Korea's Kospi slid 1.17% to 3,568. Malacca Securities said the sell-off was likely a knee-jerk reaction to the negative developments in the U.S., noting that bargain hunting could emerge as investors digest the fairly positive measures in Budget 2026. The full implementation of e-invoicing in 2026 may benefit AutoCount.com Berhad, which started its breakout last Friday. It added that other budget-related beneficiaries include technology, utilities, and renewable energy RE sectors, supported by the government's AI initiatives, water infrastructure projects, and the LSS6 solar program. Malacca Securities also pointed to renewed investor interest in the upcoming listings, including the IPO for Insight Analytics Berhad, which closes today. Taking a more cautious view, TA Securities said the local benchmark is likely to extend its profit-taking consolidation phase as technical momentum and trend indicators continue to signal weakness. Last week's choppy and indecisive trading sessions highlight the prevailing market hesitancy, with the FPM KLCI showing no strong directional bias. The firm noted that while sectors tied to Budget 2026 measures may see selective buying, the broader market is expected to remain in consolidation mode amid weak sentiment. TA Securities added that concerns over the ongoing U.S. government shutdown could further dampen regional sentiment, as heightened political tensions in Washington suggest that the stalemate may persist in the near term. Moving on to local currency update. The ringgit opened flat against the U.S. dollar on Monday morning as investors stayed biased towards the greenback, although positive local developments following Budget 2026 helped offset downward pressure. At 8 a.m., the local note stood unchanged at 4.2200 or 4.2260 versus the greenback, compared with Friday's close of 4.2200 or 4.2260. Bank Muamalat Malaysia Berhad Chief Economist Dr. Muhammad Afzanizam Abdul Rashid said the Budget 2026 announcement reaffirmed the government's commitment to fiscal discipline, with the fiscal deficit expected to narrow to 3.5% of GDP in 2026 compared with 3.8% this year. Perhaps there could be some support for the ringgit after experiencing a correction. The ringgit is expected to hover around 4 ringgit and 20 cents to 4 ringgit and 21 cents today. Meanwhile, the US dollar index DXY was on a weaker trajectory at 98.978 points, down 0.58% last Friday, after US President Donald Trump threatened to impose 100% tariff imports on all exports from China to the United States. At the opening, the ringgit traded lower against major currencies. It eased vis-a-vis the Japanese yen to 2.7756 or 2.7799, slipped against the British pound to 5.6295 or 5.6375, and fell against the euro to 4.8960, 4.9030. Against ASEAN currencies, the ringgit was mixed. It declined versus Singapore dollar to 3.2524 or 3.2575 and weakened against the Thai baht to 12.9186 or 12.9457. However, it remained flat vis-a-vis the Indonesian rupiah at 254.6 or 255.1 and unchanged against the Philippine peso at 7.24 or 7.26. Continuing with some local economic updates. The Malaysian ringgit is poised to extend its rally, supported by strong domestic spending and prudent fiscal management. This was said by Second Finance Minister Datuk Seri Amir Hamzah Azizan. He noted that the currency could strengthen to just below 4 ringgit per US dollar within 12 months, marking a more than 5% gain and reaching its strongest level since 2018. Amir Hamzah told that the ringgit is still resilient because the fundamentals are still strong. He added that even if the US Federal Reserve slows its pace of easing, the ringgit still had a lot of wind behind it to push ahead. The ringgit has appreciated nearly 6% this year, making it Southeast Asia's best performing currency. Policies such as civil servant wage hikes and a high employment rate have helped boost domestic consumption and economic resilience. He explained that the government is placing money in the hands of the people and small and medium enterprises to support inclusive growth. The economy is expected to grow 4% to 4.5% in 2026, compared with the projected 4 to 4.8% in 2025. Analysts anticipate a third quarter GDP growth of about 4.2%, down slightly from 4.4% in the second quarter. Prime Minister Datuk Seri Anwar Ibrahim's Budget 2026, tabled on Friday last week, proposed a 470 billion ringgit expenditure plan for next year, including state-linked spending. The government aims to narrow the fiscal deficit to 3.5% of GDP in 2026 from 3.8% this year, despite declining oil revenue, which has halved as a share of the total income since 2009. Anwar, who also serves as finance minister, did not introduce new subsidy cuts or taxes. However, he announced higher excise duties on cigarettes and alcohol starting November and confirmed plans for a carbon tax targeting the iron, steel and energy sectors in 2026. Amir Hamzah said these fiscal measures, including the expansion of sales and service tax (SST) and digital e-invoicing, will enhance tax compliance and reduce reliance on oil and gas. The Institute for Democracy and Economic Affairs Ideas noted that while Budget 2026 lacks major structural reforms to diversify the tax base, efforts to improve compliance and curb leakages are commendable. Ideas highlighted that Petronas proposed 20 billion ringgit dividend for 2026, half of what it paid in 2023, will reduce overall revenue growth relative to GDP. Budget 2026 manages improve. Ideas said that Budget 2026 manages immediate pressures, but lasting progress depends on the government's ability to turn fiscal restraint into reform. Looking ahead, one new revenue source under consideration is rare earths mining and processing. Malaysia aims to capitalize on growing demand for minerals used in electronics, electric vehicles and green technologies. Sovereign Wealth Fund Khazanah Nasional Berhad will partner with global firms to develop downstream rare earth processing, according to Anwar. Amir Hamzah said the government is currently mapping reserves to assess their potential, adding that Malaysia is in early stage talks with foreign governments about strategic partnerships. He said some reserves have been identified in Terengganu, Kelantan and Kedah, all opposition-controlled states, and that the government aims to build this new economic leg carefully and strategically. Moving on to corporate news update. Prices of alcoholic beverages in Malaysia are expected to rise by up to 5% next month, following the government's planned 10% excise duty hike under Budget 2026, according to RHB Investment Bank Berhad. Analyst Sung Wei Siang said major brewers Heineken Malaysia Berhad and Carlsberg Brewery Malaysia Berhad are likely to fully pass on the higher tax to consumers rather than absorb the additional cost. Soong noted that the brewers are expected to adjust their average selling prices by about 4 to 5%, adding that the move would likely result in a short-term dip in demand before consumption stabilizes as drinkers adjust to the new pricing structure. He recalled that during the last excise duty hike in 2016, both Heineken and Carlsberg continued to post earnings growth despite higher retail prices. While we are negative on the excise duty hike, the last increase did not lead to adverse earnings impact. Both brewers recorded growth in their Malaysia operations after 2026. He said this, adding that the impact at this time could be more noticeable since beer prices have already risen twice in the past 2 years and household budgets remain pressured by inflation. Soong also warned that the wider price gap between legal and illicit alcohol could allow contraband beer, which currently accounts for about 25% of the local market, to regain market share. Despite the headwinds, RHB Research expects only a modest decline in sales volumes and maintains its buy call on Heineken Malaysia, though it lowered the target price to 26 ringgit and 50 cents per share. The firm projects that profit margins will remain healthy, supported by the August price increase, efficiency improvements and lower raw material cost. Soong added that brewers could also benefit from stronger tourism demand in conjunction with Visit Malaysia year 2026, which may help offset some domestic weakness. RHB Research forecasts Heineken's dividend yield to remain attractive at around 8% in 2026, underpinned by stable cash flow and continued marketing efforts to sustain consumption. And finally, wrapping up, we have major corporate developments and deals across Malaysia. Gershon Corp Berhad plans to raise up to 103.76 million ringgit via 2 private placements to fund its acquisition of an additional 40% stake in local assemblies in Berhad, increasing its ownership to 80%. Kellington Group Berhad has signed an agreement with Selangor State Link of Worldwide Energy Development and SKS Coach Builders to develop a 2-megawatt green hydrogen production hub in Selangor. MSB Global Group Berhad has signed a 10-year exclusive distributorship agreement with China-based Zhejiang Gold Intelligent Suspension Corp. and will be the sole distributor of Zhejiang Gold's shock absorber products in Malaysia, Thailand and Singapore. Mahakama Group Berhad and KLCC Holdings Berhad are selling the 519-room Impiana KLCC Hotel for 315 million ringgit to Harum Aspirasi, mostly owned by the Valiram family, which runs a luxury retail group. And last but not least, UOA Development Berhad said its property investment unit, Distinctive Acres Syndrome Berhad, received a notice on Friday for an additional tax assessment and penalty of 165.66 million ringgit. Now that's a wrap for Morning Bell Updates with me, Anujaria, on KleverStock. Thank you for choosing us, investors. Stay tuned for the next live coming soon.